Hi, I'm Pattu from freefincal, and in this video let's discuss how much return can one get by investing in sovereign gold bonds. So the government has been issuing sovereign gold bonds every month in June. That's the schedule. So the June series is the first, the second series in July, the third series is currently on. There's one more tranche in September, and then they will make further calls on it. I had talked about buying gold in many videos. I've written several articles about it. I had mentioned that investors must first differentiate between investing in gold and actually buying gold, that is at a later date. And if you wish to buy gold at a later date, so for example, you have a daughter and let's say her marriage is 8 years away, or maybe it's 16 years away, ballpark 16 years away, uh, then you can simply buy sovereign gold bonds, and that is a risk-free way, literally risk-free way of saving for your daughter's marriage expense gold, uh, because all you're doing is tracking the price of 24 karat gold, and you can always redeem that money after 8 years if that's when you need it, or buy one more tranche, and after 16 years you can redeem it, and so on. Since your ultimate aim is guaranteed to buy gold, then you're tracking the price of gold. There's literally no risk involved, absolutely no risk involved. It doesn't matter to you whether the gold price goes up or down, because you're going to buy only that commodity, whatever price you're going to buy it. So there's absolutely no risk involved from that point of view. But if you're investing in gold, if you want it to be part of your portfolio, which means it has to be part of your asset allocation, then sovereign gold bonds are not a good medium. Gold ETFs are a better way to have it, because people say they want gold to be part of the portfolio but don't understand that they have to rebalance it. If you are having small exposure to gold, let's say 5%, tomorrow it can become 10% very quickly if equity crashes. Then what will you do? You have to rebalance it, right? So for that you need to be able to sell, and you need to also, if you are buying, I have made it very clear several times that gold price movement is extremely volatile, and it is as risky as stock price movement, and in fact sometimes even more, because there are two commodities. The forex movement is also linked to gold INR movement. So you should need, either you have it part of your asset allocation by buying ETFs. If you want for investment, you're tracking the price for investments, or you must do tactical buy and sell using 200 DMA or something like that, some other indicator like that. So that is what you should be aiming for. So you first be clear about what your goal is. So I have several videos on this, articles on this. Please have a look at that. The RBI has a very good FAQ page on the technicalities associated with the bonds, where to buy them, how to buy them, what is the interest rate, what is the taxation, etc., etc. If you hold for 8 years, there's no tax. But all that is fine. But just because something is tax free doesn't mean you can use it as an investment, because you should be able to sell. And if you're I mean, you should actually look at a demat account, look at the price at which the bonds are trading, and whether you'll make a loss if you sell them, and so on. So you should track that, then only decide whether you're going to buy SGBs with the intent of selling midway. Otherwise, the ETF is the best method if your intention is to sell midway. But if you're going to hold to tenure with the intention of buying gold later on, then SGB is a fantastic investment. There's no question about it. However, when that's again that the reason why I keep saying it again. If your intention is to buy gold at a later date, returns should not matter to you at all. So from that point of view, it is irrelevant. But as an investor, if you want to say, okay, I'm going to buy the bonds and take part in the price of gold, and what return will I get after 8 years? Well, then here's the answer. So these are 5,991 8-year returns of gold. The gold per gram in INR. The lowest return, 8-year return, is negative. It's about 1% or so, about close to -1%. The highest is 22, 23% or so. You can get any return from that, from -1 to -23%. It's up and down, it's almost cyclic. You decide what, if this, please don't take average, that's stupid. Please don't take the median, that is stupid. You cannot do anything about it. The answer is we don't know. It can be anything. The return can be anything because it is extremely volatile. So please don't expect 5%, expect 7%. That's a stupid, expect it to beat an FD. No, you cannot have any kind of expectation. And for God's sakes, please don't say that 2.5% interest that you will get from the bond should be added. Oh God, don't be a rich person in mentalities. Don't buy gold bonds for 2.5% interest, which is fully taxable as per slab. Oh, that's just stupidity. The answer is nobody knows. That is the answer. And the same 8-year data, this is in comparison with Sensex returns. This is the price return in the Sensex. Of course, the dividends, because I'm doing it from 1979, the dividends will be about 2%. You can push up the graph by 2%, but notice that the risk levels, the fluctuations, the range of fluctuations are comparable. That is why if you look at the SEBI riskometer for mutual funds, gold mutual funds, gold ETFs, gold fund of funds, whatever, the riskometer reading will be it will be higher than the diversified equity funds. It will be comparable to the sector or thematic funds. It is extremely volatile. You can compare the standard deviations at value research for equity funds and gold and come to the same conclusion. So that's the kind of returns you can expect after 8 years. The answer is anything. So please check out the other videos or articles on gold, and if you have any questions, please leave them below. Bye bye.